latest set of purchasing managers' indices for the manufacturing and services industries are due for release across the globe, including the UK, on Wednesday the 23rd of August. And the latest US durable goods order numbers are due in America on the 24th. But the biggest macroeconomic feature of the coming week will run from Thursday the 24th to Saturday the 26th. And it is the latest annual Central Bankers Symposium at Jackson Hole, Wyoming, USA, hosted by none other than the US Federal Reserve. Some investors will hang on every word, in the view that central bankers remain masters of the universe, able to control inflation and maintain both economic growth and financial stability through their deft use of interest rates and sometimes less orthodox tools, such as quantitative easing or even quantitative tightening and yield curve control. Other investors will view the event as nothing more than a meeting of prolix, self-important windbags who have never correctly called a recession in their lives, left monetary policy too loose for too long, and made a mess of their recent call that inflation would prove transitory. You may in fact go for a middle path, but whichever view you take, it will be yours, but markets will be looking for hints on the trajectory of interest rates, inflation, the global economy, and anything else the central banking cohort decide to discuss. On the home front, we have a relatively quiet week ahead here in the UK, with just one FTSE 100 member scheduled to update its shareholders, alongside a smattering of mid and small caps. Companies which may be worthy of further research include the following, although again some of these dates could yet be subject to change. John Wood on Tuesday the 22nd of August, Costain on the 23rd, CRH, Lookers, Hunting, Hayes, Sofyon and Harbour Energy on the 24th, and PureTech Health on the 25th. This is no way meant to diss those names or slight them, but the company most likely to cause a fuss in the coming week actually comes from the other side of the Atlantic, and that company is silicon chip specialist NVIDIA. It's due to report its second quarter results for the 3 months to the end of July on Wednesday the 23rd. Again, this isn't to disrespect that list of UK firms, but at just over $1 trillion, NVIDIA's market cap dwarfs that of the entire list I just mentioned. In addition, NVIDIA shares are up by 190% in the year to date as I record this, and it's therefore one of the so-called Magnificent Seven, alongside Alphabet, Amazon, Apple, Meta, Microsoft and Tesla, that have generated the vast majority of the gains in the US headline indices in 2023. For the record, NVIDIA, which designs its chips but then outsources the manufacturing in a so-called fabless model, is actually the single best performing stock in the S&P 500 this year as I record this. What longtime Chief Jensen Huang therefore has to say about current trading matters for 3 reasons. First, again, NVIDIA has been such an important factor in broader US equity market performance in 2023. Second, silicon chip stocks are a good guide to the global economy by dint of their sheer ubiquity. This is a $600 billion a year industry sales-wise, and semiconductors can be found in everything from smartphones to servers, robots to smart meters, and cars to laptops. Finally, the 30 Stock Philadelphia Semiconductor or SOX index, of which NVIDIA is a member, can be seen as a pretty fair guide to investor risk appetite. Chip stocks feed off positive earnings momentum, loving upgrades, and hate negative earnings momentum, recoiling from downgrades. If the SOX is buzzing, then the chances are the wider indices are too, although the opposite can hold true. A droopy SOX index can be the harbinger of trouble ahead, at least looking at the index's history since its inception in summer 1994. And so to NVIDIA itself. Last year's share price slump after a profit warning, a slowdown in demand for graphics card sales, and a surge in inventory all seem like a bit of a distant memory after May's much better than expected first quarter results and huge upgrade to second quarter revenue and profit forecasts from Mr. Huang. And it's against that guidance that these Q2 figures will be benchmarked, while analysts will also look for any steer on the rest of the year. Thanks to the shift towards generative AI and accelerated computing, whereby core control remains on the central processing unit, CPU, and data-intensive tasks are managed by a separate acceleration device, NVIDIA has guided second quarter sales to $11 billion, miles above the $6.7 billion achieved in the same 3-month period a year ago. For the third quarter, analysts are currently expecting $11.9 billion in sales, compared to $5.9 billion in 2022. Mr. Wang's guidance for cost of goods, operating expenses, interest expense and tax implied a second quarter net profit figure of around $4.5 to $5 billion and earnings per share of around $2 a share, a number that comfortably exceeds the quarterly record of $3 billion in net profit chalked up in late 2021. The consensus earnings per share figure for the second quarter is now $2.06, and for the third quarter it's $2.22, or $5.5 billion in net profit. Stories of panic buying of NVIDIA's graphics processing units, especially by Chinese and Middle Eastern internet firms, worried sanctions may keep them out of the market in the case of the Chinese, could make for a strong quarter. But one other figure to note is inventory. As demand slowed in 2022, NVIDIA built up a big bulge of unsold product. Some said those chips were a buffer against supply chain disruption. Others argued it was a sign of overproduction and trouble ahead. At the end of the first quarter, inventory stood at $4.6 billion, or 165 days worth of production. A reduction in both figures would be a welcome development. I hope that you and your families are all in good spirits and keeping well despite the wet weather. Thank you for watching, and I look forward to seeing you again next week.